We're now joined by Peter Lenardos of RBC Capital Markets. So welcome to On the Move.
Good morning.
Peter, talk me through a little bit about these figures, because they were actually significantly better than what we saw at the same time last year. But this is because of what happened in Italy. Overall, though, it's one, I guess, of the only companies that do well in volatile times.
Right, but I think it's more than about Italy. What the market was looking for was about an 18% increase year on year. We got a 21% increase. We were looking for a 33% increase in EPS. We got a 38% increase. And I think the surprising thing, it was not only about the Italian banking operations where they got a lot of extra interest, but it was also their capital markets division was quite strong. Their information services business was quite strong. Their post-trade service was quite strong. So the scale of the beat is impressive because it was so broad-based. And now the shares are up about 20% year to date, which is good, but it's impressive given especially the market backdrop. But yet all of this growth is not reflected in the LSE's valuation. So I think when you look at compared to competitors, it's still attractively priced, well positioned for growth.
So do you think they're cheap actually because investors are focusing on the fact that they haven't found a partner to consolidate with, and so they're focusing on that instead of seeing the true value in the company?
You know, I don't think that's the reason, because I think that you have many deals that are in the exchange's graveyard. NYSE, Euronext, and Deutsche Börse, LSE itself, and the TMX, the Australian exchange and the Singapore exchange. But if you look at what the LSE has done, it's all starting back with when they acquired Millennium IT, and then Turquoise, and then FTSE International. They paid $450 million for a 50% stake in December, and now they're spending about $500 million on LCH Clearnet. They are actually one of the few exchange groups that are finding partners, integrating these partners, and then driving revenue and cost synergies. So I think a strategy, I mean, Xavier Rollet now has been CEO for 3 years coming this weekend. He's done a great job in terms of EPS accretion, revenue growth, and positioning the company for long-term growth.
Because they need to diversify.
That's correct.
This is what they need to look at in the longer term. What kind of routes will they go down?
You know, I don't think it's only that the LSE needs to diversify. I think
no, it's all the exchanges, right, of course.
It's all the exchanges
they need to make money.
Are looking to diversify away from cash equities, so away so we get out of the headlines talking about volumes on their exchanges. And I think that what the LSE is doing, it's something that Deutsche Börse has done years and years and years ago, is focusing on IP, intellectual property. That comes through indices. Focusing on clearinghouses to be adequately diversified, to take advantage of this regulatory change that's coming through MiFID II, through EMIR, that's going to force a lot of these OTC derivatives through centrally clearing and then eventually on exchange.
Although, Peter, if you look at the volumes, actually they're not doing too bad at all at the moment because of all this volatility. We're just hearing this morning from the German finance minister saying he's expecting markets to remain shaky for the next 12 to 24 months. So will it be the exchanges that kind of benefit from this directly?
That's a great question, because that shows one of LSE's weaknesses, that the volatility will benefit exchanges that have derivatives products. But if you look at LSE's revenue, only about 2% of their revenue is coming from derivatives. So in order to grow this business, what the LSE has done a fantastic job is diversifying this far. But when we go forward, we're going to want them to develop a derivative offering. And how they're going to do that is by taking their FTSE licenses, taking their the liquidity that they're going to get from their clearinghouse, and hopefully grow their derivatives platform. If they can do that, they'll be able to capture a lot of this increased volume.
Now, the dividend was just a touch short of what actually the analysts were expecting. Is this just, does it make really any difference? I know a lot of investors are now looking at the UK market to make sure that they do get that dividend.
Right. LSE, though, I don't think is a stock for dividend players. LSE is about is a growth story. What they are doing is they're taking low-cost debt and they're making very accretive acquisitions in high-growth markets. So this is not a dividend play. For investors who are looking for dividends, they should look across the channel to Deutsche Börse, which is going to pay them a very nice dividend, regular dividends, special dividends, share buybacks. LSE is only going to offer the regular dividend. They're going to increase it 5% per year, but this is all a growth story here.
All right, Peter, thank you so much for your time.
Thank you, Francine.
Peter Lenardos there of RBC Capital Markets.